Your LLC is broken. Maybe you filed it years ago and you forgot about it. Maybe you've been commingling funds. Maybe you don't have an operating agreement, and maybe you've missed some filings and other formalities, and you don't even know it right now. But here's the good news. You can fix all of this before somebody sues you, before opposing counsel starts digging, someone like me gets into your business, before a judge decides that your LLC is worthless. I'm Karam. I'm the 20-year battle-tested lawyer. I've advised entrepreneurs on over $1 billion worth of deals, and I've actually prosecuted and defended cases involving allegations of LLC violations and alter ego claims and all that good stuff. So today, I'm going to walk you through the actual factors that the courts look at when they decide that they're going to pierce your LLC, and the specific mechanisms that can cure each one of those factors so you can help yourself before it's too late. This is real compliance, the real path to making your LLC legally bulletproof. So let's jump right in. But before we get into the fixes, you need to actually understand how courts think about all of this. So when a court decides whether they're going to pierce your LLC and hold you personally liable, they're doing what's called a balancing test. They look at multiple factors. They weigh them against each other, and they make a judgment call, really. There's no bright line. There's no magic number. I can't tell you if you've got 3 factors, you're fine. 4 factors, and you're pierced. No lawyer can honestly tell you that, right? The judge applies factors. They balance it. It's pretty subjective, to be honest with you. Actually, most of the court is. So what courts are really asking is, does this LLC look and operate like a real separate business? Or does it look like this person just created a shell to hide behind? The more factors that look bad, the worse it looks overall. The more factors that you've cured and documented, the better your position, the more reasonable you look. So what I'm going to do today is show you how to go through each major factor, assess where you stand, and implement specific mechanisms to cure any of these deficiencies so that your LLC is compliant before you know it. Here's factor number 1, and maybe the easiest thing, the operating agreement and corporate records. This is one that's going to be easy to prove against you in court. Courts want to see that you have a governing document. That's an operating agreement for LLCs, and that you're actually following it. It's really important. And courts frown upon business people who aren't sophisticated enough to understand the law. And trust me, there's no sympathy for business owners in court. The judge is not going to care about you. So you have to really assess yourself, and you have to ask, do you have a written, signed operating agreement? And I mean a good one. And does it reflect how your business actually operates today? Are you acting consistent with it? Have you documented major decisions with actual written resolutions? Can you bring them up today? Did you follow the procedures in your operating agreement? If you took significant big business actions like taking on debt, selling assets, bringing in an investor, did you document them properly? And do you have a system in place to actually operate and maintain your LLC? Can you produce your LLC books instantly? And are they compliant? So here's what sophisticated compliance looks like, and it's not even that sophisticated. Every major decision gets a written resolution, signed, dated, filed in your corporate records. You brought in a new member, you need a resolution authorizing the admission, an amended operating agreement reflecting new ownership percentages, new voting, new documentation of capital contribution, new everything. Have you removed a member or had any sort of buyout? You need a resolution, documentation of the buyout terms, proof of payment, and an actual amended operating agreement. Have you took on any significant debt? You need a resolution authorizing it, made a large purchase or sold a major asset. You need a resolution. If you don't have an operating agreement, you're operating under state default rules. Even if you didn't intend it, you didn't know about it. And here's what most entrepreneurs don't realize, unfortunately, until it's too late. Those default rules have specific procedures for major actions. So if you didn't follow them, those actions might not be considered legally valid. So the cure here is get yourself an operating agreement in place. Then go back and ratify any major decisions you made without proper documentation. Do it the right way. A ratification resolution says that the members hereby ratify and confirm the following action that was taken place on so-and-so date. It's not as good as doing it right the first time, but it's way better than doing nothing at all, and it's very reasonable for you to do it that right. Factor number 2 is separation of identity. This is where a lot of entrepreneurs get really, really sloppy, and it's easy to do. Courts look at whether you and LLC are truly separate. separate, or whether you've blurred the line so much that the LLC is really just you. That's the alter ego theory. And that means mixing all your money together. And it also means having the same business address as your personal residence with no separation. That's a problem. Having the same phone number for personal and business, that could be a problem. The same employees working for you personally and for one LLC and for another, and without clear distinctions, that's a problem. Running multiple businesses out of the same LLC without any separation, another problem. Signing contracts in your own name instead of as an authorized representative of the LLC, problem. No operating agreement, problem. No SOPs, problem. But thankfully, there are specific mechanisms to fix all of this. So if you run your business from home, designate a specific space as the business location. Give it a separate business mailing address if you can, a PO box or a virtual office. Use it on all business documents. Get a separate business phone number. They're really cheap now. It's easy. There's no excuses. If you have employees or contractors, make sure their agreements are with the LLC, not with you personally. Make sure they're paid by the LLC. Make sure you're signing on behalf of the LLC. Make sure that's all clear. And if you're running multiple businesses or different business models, consider whether they should be separate LLCs at a minimum. Keep separate books and records for each of your business projects. Don't let them blend together. On every contract, every invoice, every proposal, sign as the LLC. You're the managing member. Use the right terminology. You're not just a personal name. This factor is about consistency. Every touch point should reinforce that the LLC is a separate entity. It's not you in disguise. And I see this problem all the time. And if you're running multiple LLCs, keep them separated. That's a big problem, or they could all be jeopardized just by one liability inside one LLC. So let's go to factor number 3, and that's complete financial separation. This is probably the most dangerous factor because it leaves a paper trail that's very easy to uncover. When opposing counsel subpoenas your itemized bank records, your books, financials, tax returns, sometimes your phone records, I've gotten them. They see everything. I can see who you spend your money on all the time. So how do you assess yourself? You're going to ask yourself, does your LLC have its own dedicated bank account? Does it have its own credit card? Have you ever paid personal expenses from business accounts? Have you ever deposited business income into personal accounts? This stuff needs to be cleared out. Did you transfer any money back and forth without documentation? Are you paying yourself a consistent documented amount, or you're just taking money whenever you need it? Now remember, this isn't an old school cash pizzeria business. So here's the sophisticated cure. Number 1 is complete separation moving forward. No exceptions. Business account for business only. Second, go back through all your records and categorize every transaction. Personal expenses paid by the LLC need to be identified as such and addressed. So here's a method you can use that most people don't know about. So if the LLC paid personal expenses, you can document those as either distributions to you or loans from the LLC to you. If you treat them as distributions, make sure your operating agreement allows distributions and that you're treating them consistently for tax purposes, because I can get your tax returns and any inconsistency is going to kill you. So if you treat them as loans, you need a promissory note. The LLC loaned you money, you owe it back. There should be a reasonable interest rate and you should actually be paying it. Now, do this by resolution so it's completely documented if you have to cure this issue. Alternatively, you can reimburse the LLC, write a personal check back to the business for the personal expenses it covered. Document what you're reimbursing and why. Now, moving forward, pay yourself through documented distributions or reasonable salary. Give yourself an employment contract. Keep a consistent schedule. Document every payment with a resolution or a written record. Treat yourself like a big company. So when your books are clean, they tell a story of separation. When they're messy, opposing counsel will use them to paint a picture of alter ego and dive even deeper into your business. And I've done that. Now hit the subscribe button. If you like this video, drop me in a comment if there are any other videos or topics you want to see me do. Now, factor number 4 is adequate capitalization. The courts are going to ask that this LLC have enough capital to reasonably operate and meet its obligations. So how do we really assess this, right? You got to ask yourself, does your LLC maintain operating capital? Could it pay its debts if they came due? Or is your LLC constantly running on empty, depending on random injections of cash by you? So the sophisticated approach is first document all capital contributions. When you put money into the LLC, it should be recorded as a capital contribution in your books, and it should be reflected in your operating agreement. Second, maintain adequate reserves. How much depends on your business, really, but the analysis is, could this LLC pay its reasonably expected obligations without you personally stepping in? Third, if the LLC borrows money from you, document it properly. A written promissory note in reasonable terms, like I said, an actual repayment over time that's consistent with the note. This shows that the LLC is functioning as a separate borrower, not just as an extension of your personal wallet. What kills you here is in an LLC that has never been funded. You created it, you never put real money in, and you used it to shield a business that should have had real capital, and you had real capital. Courts can see right through that, but here's my advice. If you just started the company on shoestrings and you really have no money to really capitalize it adequately, I'd make sure that you document all that. Make it part of the brand story, because this could be a defense down the road just in case someone claims you intentionally undercapitalized the company to avoid liabilities, when in reality, it was simply undercapitalized because you had no choice. And it's not out of bad faith. That's a legal term you're going to start really hearing a lot of. So now factor number 5 is ongoing state compliance. Now you have to remember that not only are you subject to FTC, federal laws, state laws, all sorts of stuff, that every LLC follows state law. And you have to follow the regulations, otherwise the LLC won't protect you. So you have to ask yourself, is your LLC in good standing right now? And you can go check those records. Are you current on all annual reports of franchise taxes, all those sort of formalities? Do you have an active registered agent? If it's required in your state, have you filed any required statements or disclosures? The cure is straightforward, but it's really critical. If you're behind, get current immediately. File the missing reports, pay the fees, reinstate. You've got to create a compliance calendar with every deadline and check your status regularly. So here's what most people miss. When your LLC is not in good standing, or worse, it's been dissolved, you may have been operating as a general partnership or a sole proprietorship without even knowing it, meaning you don't have legal protection and you're personally liable for things that you did during that period. So you have to get current, stay current. This is non-negotiable. Keep monitoring your LLC, because you're the only one who can save your LLC. It's not going to save you. So factor number 6 is documentation of all intercompany and related party transactions. This is where sophisticated compliance separates the amateurs from those who actually make it. Here's what courts look at. If you have multiple entities, are the transactions between them documented at arm's length? That's a legal term. Or do assets and money just flow back and forth with no proper paper trail? So if the LLC pays for something that benefits you personally, or vice versa, is it documented properly? If you loan money to the LLC, or the LLC loans money to you, are there written agreements? Are they written in good faith? And do they have sufficient terms? Now, the way to cure this is that every transaction between related parties needs documentation. If your LLC pays another LLC you own, there should be an invoice, a service agreement, something like that shows why the payment was made, a connection. If you provide services to your own LLC, there should be a management agreement or consulting agreement between you and the LLC. Even if it's with yourself, it shows the relationship is formal and documented. I'm going to be asking for it as the attorney in litigation. If you use personally owned equipment or property for the business, there should be a lease agreement. The LLC pays you rent. Has to be documented. This matters because when opposing counsel like me looks at your records, sees money moving around with no explanation, they argue it's just all one pot, it's all your pockets, there's no separation, the LLC is a fiction. And you're not going to remember any of this stuff when you're actually in court, so to document it is the best policy. And imagine if you're trying to exit and sell your business and you don't have all these agreements and contracts, and I've represented investors looking at businesses like this, I tell them to run away. So when every transaction is documented properly, you're showing that you respected the boundaries between entities. That's evidence of real separation, and it's also evidence of real sophistication. Now here's the reality of everything. Courts look at all of these factors together. They balance them. They ask overall, does this look like a legitimate separate entity? Or does this look like a sham? One weak factor with everything else strong, you're probably okay. Multiple weak factors, the picture gets bad. It gets a little worse, but here's what matters. If you're watching this video right now and you're taking the steps right now to cure your deficiencies, if you recognize the problems and you're already actively implementing these solutions, that goes a long way, and you're not doing anything intentionally fraudulent. Courts appreciate good faith, reasonable efforts. That's what they're called. They understand entrepreneurs aren't perfect. What they don't like is someone who created an LLC and completely ignored it. Someone who never tried. You're here. you're learning, you're taking action. That puts you ahead of most of the game. And if you implement what I've shown you today, the resolutions, the documentation, the operating agreement, the separation mechanisms, the proper loan documents, the transaction records, I know it sounds like a lot, but it's really not. You're going to build an incredible business defense system. Let me give you some honest advice from someone who's been in the courtroom, defending this stuff, going after it, right? Going through these factors yourself is going to be eye-opening. Assess where you stand and implement the solutions now before it's too late. And if you've got any questions, feel free to reach out to me. I'm here to help you. And I've created a valuable resource for you that I sell, but I'm going to give it to you here for free. It's called the Alter Ego Checklist because I want you to understand the law. Click the link below. Like I said, it's free and it'll walk you through exactly what courts look at to pierce your LLC. So you can actually learn the law and be informed. And if you go through this and you find significant problems, if multiple factors look bad for you, have a consultation with an attorney who actually understands this stuff. So grab the free Alter Ego Checklist, click the link below. It'll help you assess exactly where you stand on each factor. And if you want to go deeper, I also offer you a free risk report. You know where to get that, and an action plan to get your business legally bulletproof. All you have to do is answer some of my proprietary questions about your business, and we'll audit it for legal risks, all for free, and we'll send you back an actionable plan to actually fix these problems before it's too late, because this is what it's all about. Click the link below to the risk report. Make sure you subscribe to the channel. I've got a whole series on protecting your LLC and much, much more. It's all part of Business Defense 101. And always remember, defense wins championships. I'm Karam Nahas, the battle-tested lawyer. Stay legally bulletproof.